In this example, we're going to be looking at decision making. So we're going to look at the difference between whether the company should make a product or buy it externally. So in this case, they tell us that Fresh Foods is a large restaurant chain, and they need to determine if it would be cheaper to produce 5,000 units of its main food ingredient for use in its restaurants, or to purchase them from an outside supplier at $12 each. They've provided us cost information on internal production, and it includes direct materials, direct labor, variable manufacturing overhead, variable marketing overhead, and fixed plant overhead, and they've given us the total cost and per unit cost for each category. They tell us that the fixed overhead will continue whether the ingredient is produced internally or externally. There is no additional cost of purchasing will be incurred beyond the purchase price. So they want us to determine what our alternatives are for Fresh Foods, what our relevant costs are for both internal production and external purchase, which alternative is more cost effective and by how much. And then in part 4, it says to now assume that 20% of the fixed overhead can be avoided if the ingredient is purchased externally. Which alternative is more cost effective and by how much? So question number 1 asks us for our alternatives. So our alternatives are make or buy. That's the options that we have. The second question asks us for our relevant costs. And a relevant cost is a cost that is going to differ amongst alternatives. So when we're thinking about our relevant costs, we want to look at 2 pieces. We want to look at those relevant costs to make the product and the relevant costs to buy our product. And again, relevant costs are costs that are going to differ amongst alternatives. So, for example, when we decide to make the product, we are going to have to invest in direct materials. And our direct materials on a per unit basis is $5. If I buy the product, I don't have to buy those direct materials. I'm also going to have direct labor if I make it. It's $3 per unit here. And again, if I buy the product, I don't have to incur that direct labor cost. We have variable overhead that we're going to have if we in fact make that product of $1.50. We're also going to have our variable marketing overhead. They told us it would be $2. And then they told us that our fixed overhead is $6 a piece. But in the additional information that it provided, it tells us that our fixed overhead will exist regardless if we make the product or buy the product, which means that it is not a relevant cost. It's not going to differ amongst alternatives and therefore should not be considered as part of one of the pieces that we look at to make this decision. We also have the purchase price. I don't have to purchase it if I make it, but I do have to purchase it if I buy it. So we add up our costs on a per unit basis. So to make it in total is going to cost us $11.50. To buy it, it would cost us $12. Again, the fixed overhead is not included in this component because it doesn't differ amongst alternatives. We are going to have to pay those fixed costs regardless of what decision that we make. So in part 3, it asks us to determine what is our better alternative. So we know that every company goes into business to make money, and the best way for us to make money is to keep our costs low. So in this case, our best option would be to make the product because it would be cheaper. We would save 50 cents per unit. They tell us that we have to create 5,000 units and we'd save 50 cents, so we would have a bottom line increase of $2,500 if we chose to make it versus buying that product. In part 4, they're changing one component. They're saying that 20% of our fixed overhead can be avoided if it's purchased externally, meaning that 80% of our fixed overhead is irrelevant because it's going to be there regardless if we make the product or buy the product, but 20% isn't. So 20% of our fixed overhead now becomes relevant in our decision making. So We have 20% of avoidable fixed overhead. So let's look at our options again. We have our make and we have our buy. And again, relevant costs are going to differ amongst alternatives. So again, direct materials is going to differ. Direct labor is going to differ. Our variable overhead is going to differ amongst alternatives, as well as our variable marketing overhead. And we also have avoidable fixed overhead. So we had in total on a per unit basis, $6 per unit of fixed overhead, and 20% of that is relevant in our decision because 20% more will be there if we make it, and that 20% will not be there if we buy it. So 80% of our fixed overhead is irrelevant, but 20% of it is relevant in our decision making. And then therefore it's going to cost us more to make that product because we're going to have 20% more of overhead. We also have the purchase price, which has not changed, and that's at still $12 per unit. So now when we look at our options, in order to make the product, it will cost us $12.70. To buy it would cost us $12. So our decision in this case should be to buy the product. It would save our company 70 cents per unit. And again, 5,000 units at 70 cents per unit, it would save us $3,500 by buying the product if 20% of our fixed overhead is in fact avoidable if we buy it versus if we